Celebrity investor Cathie Wood has been warning of an imminent economic recession.
The yield curve has inverted. Every time the yield curve has inverted within 12 months to 18 months, we have been in a recession.
And even beyond the yield curve, Wood has called out several areas of the economy that could signal we are headed for runaway inflation without any increase in wages, causing a complete economic collapse unlike any we've seen since the 1970s.
That's the great fear, that we're in a replay of the 70s, where we reached double-digit inflation and interest rates.
So in this video, we'll look at Cathie Wood's thoughts on how the current high inflation rates we're seeing, topping 7.9% year over year, will affect the stock market, as well as if she thinks inflation will keep rising or drop. We'll also look at why she argues the US economy is starting to slow down without most people even realizing, and explain how all of this could lead to a shift in the market from value stocks and toward disruptive innovation stocks, causing these companies' stock prices to rise. So by the end of this video, you'll know not only why Cathie Wood is worried that the Fed Chairman Jerome Powell may not see signals of a looming recession, and exactly what steps you can take to protect yourself and even make a profit. Because even when the economy's crashing, we need to make tendies. So to understand where Cathie's coming from, we first need to understand what's going on with inflation. And I want to make sure we're really clear what we mean by inflation. Inflation is when prices increase throughout the economy, which means consumers like us lose purchasing power. We can't buy as much stuff as we used to. Over the past year, according to the CPI, or Consumer Price Index, compiled by the US government, we've seen prices rise 7.9% in food, 25% in energy, and 6.4% everywhere else, which comes out to a total inflation rate of 7.9% year over year. This is a massive increase compared to really anything I've seen in my lifetime. In fact, the last time we've seen sustained inflation that high was in the 1980s and earlier, with recent years seeing inflation in the low single digits. Now, normally you don't want inflation in the 10 or 15% range like we saw in the 80s, unless you're selling a commission on Wall Street, because any cash people hold loses value way too quickly. Now, normally the Federal Reserve seeks to keep inflation around the 2% rate, since that's the sweet spot for keeping it stable while protecting jobs. And that's exactly what Fed Chairman Jerome Powell's been trying to do. But clearly that hasn't worked in this past year. Now, I know what you're thinking. What does inflation have to do with an economic recession? Well, normally a recession is defined as a period where economic activity is reduced, usually with GDP dropping and unemployment rising. And usually inflation happens in the opposite of a recession, since it generally moves in the opposite direction of economic output. In fact, the Fed's best lever for lowering inflation is to intentionally try to slow down the economy by raising interest rates, making it harder to borrow money for economic activity. Makes sense so far? So as interest rates go up, inflation goes down. As the economy cools off, so does inflation. At least, that's how it's supposed to work. And the Fed's plan up to this point has followed their traditional playbook, with the Fed ready to raise rates multiple times to try to rein in inflation. But Cathie Wood has called out several indicators that she thinks everyone is missing that could signal the economy is not running too hot and in need of rising interest rates to slow it down. Instead, she thinks we might be on the brink of a recession, and the Fed doesn't even realize. Cathie Wood first called out some warning signs that were showing up in the bond market, where investors were acting as if the economy wasn't booming and causing inflation, and that it was actually slowing down. In this case, if the Fed raises rates while the economy is weak, it could end up accidentally kickstarting the next recession.
We have been flagging, the bond market itself is flagging warning signs to the Fed.
And one of the biggest warning signs here is that the bond yield of the 10-year Treasury bond is now below 2-year bonds, which in the past has been one of the most reliable indicators that we are headed for a recession. There is a better than 2/3 chance of a recession at some point in the next year, and a greater than 98% chance of a recession at some point in the next 2 years, when the bond yield curve flips, according to the Bespoke Investment Group. And Cathie Wood agrees.
Every time the yield curve has inverted within 12 months to 18 months, we have been in a recession.
On top of that, we've seen some other issues start to pop up in the economy itself. She also called out potential issues in the housing market and in capital spending, which could be a warning sign of danger to come.
In order to stay out of recession, we probably need these two sectors, housing and capital spending, to continue at a fairly strong pace. We're seeing some fraying at the edges.
And this ties in with an even larger issue, which is that every physical good, from real estate to retail inventories to cars, could be a massively inflated price bubble. Cathie Wood called out how everything in real estate, pending home sales, new sales, mortgage applications, everything is down, and yet housing prices are up, which to her means we may be reaching a point where the price of real estate is just too high for your average buyer, and people are simply leaving the market. I guess giving up avocado toast isn't enough to buy a house anymore. So what happens when supply is high and demand dries up in real estate? Well, prices collapse. We can also look at used cars, which at one point, and this was an interesting stat she threw out, at one point, new cars / used cars were responsible for 50% of inflation, with a 65% increase in used car prices from the bottom to the top. And while that rise was caused by a lack of supply due to global supply chain issues, car companies may have overcorrected and produced too many cars to make up for it, and soon prices may start dropping rapidly. So while the economy looks like it's white hot with these high prices and inventory flying off the shelves or parking lots, in reality, we may just be seeing all that pent-up demand finally getting met. And once things go back to normal, we'll be stuck with a lot of inventory and not many buyers. Especially considering your average wage earner only saw a 4.5% increase in salary while prices went up 7.9%, meaning in real terms, everyone got a 3% pay cut this year. And according to the University of Michigan, consumer sentiment about the economy is the lowest it's been since the 08-09 crisis. Not exactly a time when you'd expect people to run out and start spending money. Unless, of course, you're putting that money into public, which could give you 2 free stocks when you sign up using the link in the description. Some investors even worry inflation will keep rising despite the Fed raising rates, and will fall into the same sort of stagflation the country saw in the 1970s, where wages stagnated while people's earning power was slowly whittled away by rising prices. That would be absolutely devastating for the average consumer today, where over 60% of people already live paycheck to paycheck. But Cathie Wood doesn't necessarily think we'll see the same conditions that we saw in the 1970s.
That's the great fear, that we're in a replay of the 70s, where we reached double-digit inflation and interest rates. We don't think that's the case at all.
So let's now look at the indicators Cathie Wood thinks everyone is missing that paint a different picture of the economy, one where we won't see inflation and recession, but instead deflation, where prices actually drop, and how this will lead investors to start moving money out of value stocks and into innovation stocks. So Cathie Wood thinks we will soon see both secular forces of deflation as well as cyclical forces affecting the market. And I'll explain exactly what she means by that in a second. But it is important to note that Cathie Wood has been predicting deflation since 2021, right when we were actually experiencing rampant inflation across the board. But she did acknowledge her timing on her inflation prediction was off, and she offered some interesting points on why inflation may not just stop, but completely reverse as we head into a recession, which could counterintuitively actually be a boon for growth and innovation stocks. So according to Cathie, there are 2 types of forces pushing us toward deflation. First off are the cyclical sources. Cathie Wood's theory is that because of the supply chain issues many companies faced over the past year, many businesses just ordered loads and loads of inventory hoping something would get through, which is how they survived 2021. But now those supply chains are starting to return to normal, and the massive inventories are starting to pile up faster than there's demand for them. Sales from retail stores are already starting to slow, with sales down 0.5% if you account for inflation while inventories are rising. This means companies will need to start dropping prices to move product. Similarly, the car market is dropping, and we're seeing the price of oil start to lower even amid a global conflict involving one of the world's largest oil producers. So with retail prices dropping, car prices dropping, energy prices dropping, those are all cyclical forces that could drive deflation. But Cathie Wood also thinks there's another even more powerful deflationary force, one which is much more persistent, and that is the secular deflationary effect of innovation. Now that might seem counterintuitive. Why would innovation drive prices down? After all, iPhones seem to get more and more expensive every year. But if you think about it in terms of a single product, if I buy a phone this year, it will be worth less next year and less the year after that, because new innovation in phone technology makes it less desirable over time. Innovation as a whole also has this effect. As companies start to deploy AI to assist their workers in their jobs, those workers can produce more output for the same pay. And as the gap between worker productivity and worker wages gets larger, that acts as a downward force on the prices of goods and services. So amid a slowing economy, if the Federal Reserve decides to fight current inflation by raising interest rates, it may end up slowing the economy enough to accidentally kickstart a deflationary spiral. which honestly would not be great, but we want to be smart investors and make money no matter which way the economy is going. So what stocks does Cathie Wood think will perform well if her predictions come true? Well, if you know Cathie Wood, you can probably guess where this is going. Technology and innovation stocks that are willing to sacrifice short-term profits to focus on innovation areas and cut costs will remain competitive as they can increase their productivity fast enough to outpace deflation. Meanwhile, short-term oriented, risk-averse shareholders may force companies to focus on buybacks and short-term earnings boosts at the expense of investing in innovation, ultimately causing them to fall behind in Cathie Wood's eyes. And she calls out several technology trends that will lead the way in not just remaining competitive, but thriving over the next few years. And it might not actually be who you think it is. Cathie Wood is actually not a huge believer in the FANG stocks like Meta, Apple, and Google that have dominated technology over the past decade. Instead, she says some of these former disruptors are now being disrupted themselves by smaller innovation stocks, and that those same smaller stocks have been beaten down even more by the market than the NASDAQ in general. She said, quote, "Our technology stocks are way undervalued and we're running a deep value portfolio." Let me tell you, she's not just bullish on these stocks, she's extremely bullish.
We have watched our research point to an expansion in the market cap opportunity associated with disruptive innovation from $75 trillion to $210 trillion.
That is $210 trillion with a T, as in 210,000 billion dollars. Now that seems like a high valuation, but Cathie backs it up with the sigmoidal theory of business, which basically says that innovation and technology adoption follows an S-curve, where adoption starts slowly, then takes off exponentially before leveling out. But with multiple technologies at play here, we will see an S-curve in the adoption of AI, which could in turn lead to an S-curve in the adoption of genomics, which could then feed into the next S-curve. So if Cathie's right, we'll see an exponential increase in these companies' values. And we can even look to the private markets for a peek at what the future may hold for these stock valuations.
The valuations of the stocks in the public equity markets have been crushed in the last year. But if you look at the private markets, those valuations have not been crushed. If anything, we've seen an escalation.
So maybe the public markets are taking a short-term mindset and panicking based on inflation numbers, leading them to flee from true innovation stocks and into value plays like utilities and energy. Meanwhile, the private markets that need to take a long-term view are paying more than ever for innovation and growth. When times are hard for big funds, they try to match their performance to the indexes, like the S&P 500. But Cathie Wood now thinks that today is the absolutely worst time to do that, since by focusing on high conviction positions, she can set herself up for when the market does take off. So should we all be dumping money into innovation stocks or ARK's fund? While I do think Cathie is right that innovation stocks in the public markets are being pushed down by big funds fleeing to the indexes, I personally would not invest all my money in ARK Invest. First off, Cathie Wood herself points out that disruptive innovation is inherently controversial and tends to be a very volatile strategy. And I don't think most people have the stomach for that. Just look at how many people left her fund as soon as it stopped going up in a straight line, basically selling at the bottom in January. Secondly, Cathie is obviously not an unbiased presenter. She wants more investors in ARK, so she's going to argue for why its frankly terrible performance across all of 2021 is just a temporary anomaly. And lastly, I think Cathie Wood tends to be a little bit behind smaller investors who can get in and out of positions a little more nimbly than her. She was pretty late on buying Zoom, Nvidia, and Teladoc, and I do believe a smaller, concentrated portfolio like the one I run can outperform her fund in the long term. I'm not saying she's not a good investor or that I'm better than her in some way. It's just harder to do well when the numbers get big and when you entering and exiting positions literally moves the market out from under you. But that's just my takeaway, and I'm curious what you think of Cathie's predictions. Don't forget to like and subscribe, and I'll see you next time.